So today is all about regulations, flags, controls, rules, laws, and so on. Did we discuss about regulations anytime in these sessions, in this course? What do you say? Did we? Where did we do that and related to what? Regulations. Can you help me? My memory is short. Did we discuss or not about regulation anytime?
Yes.
Yes, we did. So what was that related to? Why are we doing that again? If we have discussed. Yeah,
On the market regulators.
exactly. That was my question. So we discussed about regulations on financial markets. Let it be money market, capital market, forex market, any market, we have a regulation we have seen. When we talk about money markets, it's all about Federal Reserve or simply the Fed. Okay. And when you talk about capital markets, there are many acts, and SEC is a direct body related to capital markets. Now, what are we talking about regulations today? It is all about regulating banks, and not just banks, not banks in general. We are talking about regulation of commercial banks. Okay. So why do you think the banks have to be regulated? Because if you remember, I had been telling you earlier that markets play an important role to mobilize the capital. Same is the case with financial institutions. And financial institutions, maybe before that, we concluded that we have the economies based on market driven or institutions driven. Take for example, Germany or France or Japan. They have big banks, huge banks. They are driven, the economy is driven by the banks. They're driving the economy. That is one scenario. The other scenario, you take example of US, where it is more market driven. It does not mean that we don't have financial institutions. We have large financial institutions, including banks or commercial banks. So in contrast to these two, regulation applies to which kind of banks? In Germany or France, or in US or UK kind of markets? Markets driven, institutions driven. Where do you feel regulations are more important? What do you think?
Is it markets driven or what's the other option?
Financial institutions. Because we're talking only about regulation on institutions actually. Of course, we're talking about commercial banks only. So my question to you is, when the economy is driven by institutions, should it be regulated compared to the economy driven by the markets?
Yeah.
Yes. Both require regulations. Okay, I agree with you. Regulations are, I have to, because regulation is mandatory for any kind of industry or vertical in any economy. But the difference here is, when it is institutions driven, the regulations are completely different when you compare that to financial markets. Okay, that's what I was trying to convey. So let us take our discussions in that context. So today we have all this. We'll be working on the learning objectives. We'll be talking about financial institutions, specialness and fineness. And what are the types of regulations for these commercial banks? Then types of regulators, who is directly regulating. Then we'll be talking more on FDIC. This we discussed. Did we talk about FDIC anytime? Yes. Okay. when we are talking about commercial banking, we discussed about FDIC, because what is the guarantee for the depositors in case commercial banks default? That was more focus at the time. So we'll talk more about that, and we'll see how FDIC regulates and helps depositors to be safe with their deposits, and norms to regulate banks to give what kind of loans and to whom to give. And we also have balance sheet regulations. We discussed balance sheet operations and off balance sheet operations of commercial banks, if you remember. So regulation is more about balance sheet operation, which is core function of a bank. That's how I meant to, that's what I mean to say here as a balance sheet regulation. And we also talk about the Basel II norms, Basel 1, 2, and all. We also have some comparison on foreign versus domestic regulations. So today, the whole discussion is composed into types of regulations and how commercial banks have evolved or expanded into investment banking business, which is an extension of core commercial banking, and how FDIC evolved. Then we also have a comparison of commercial bank regulations in US with other countries. Then we try to assess capital regulations that commercial banks should meet. We'll be talking about the Basel. And finally, we'll be understanding about reserve requirements. Again, it is related to Basel, but monetary policy is more important here. Okay. You see, I mentioned as specialness and fineness. Can you differentiate these two? What do you mean by that? Specialness of financial institutions, fineness of financial institutions.
I would think that specialness is like maybe the different things they could do, and the fineness is like how, like to what extent can they do those things?
Okay, the depth of that. Okay. Anyone else? What do you mean by specialness and fineness? Yeah, you guys are right. So it's more about how the commercial bank operations are spread, how the business is done by the bank. That's how we differentiate these two. And there is a reason for that. When we are talking about fineness, to what extent they are expanding out of banking. Maybe we are talking about investment banking, broking, or securities trading, or whatever. But when you talk about specialness, it's all about the core commercial banking, the basic financial intermediation. So if someone is asking you to define a bank or banking, it's basically financial intermediation. Accept the deposits, give loans. Accept the deposits for 3 or 3.5%, give loans for 5.5 or 6 or 6.5%. The difference is the profit for the banks. So this financial intermediation is the business model for any bank. Okay. In that context, I put maturity intermediation, information provision, liquidity, transaction cost reduction, price risk reduction, and so on. So if you individually look at these things, if it is maturity intermediation, the core banking definition, then information provision, banks should be knowing about their own borrowers and depositors. We have something called soft information and hard information. Soft information is banks have very close relationship with their borrowers or depositors. Hard information is there will be a standard rule or a template to pass the information. Then liquidity is, maybe we should talk about mortgage-backed securities, where the loans are transferred or converted into securities and they trade it. Okay. Then transaction cost reduction, it happens with competition. Okay, minimum appraisal or application procedure expenses. And risk reduction happens with kind of derivatives that we have seen earlier. We have seen forwards, futures, and so on. So all these are related to the core banking, which we say specialness. Then we have fineness, where it talks about horizontal diversification. So it's more of narrow banking, broad banking, narrow banking. How do you differentiate? What could be other part of narrow banking? What do you mean by narrow banking? What could be narrow banking? Noah, would you like to try?
Good question.
The question is, I'm just saying fineness is all about narrow banking. I just started with that. Then what could be the other part of that? Got my question? Okay, I'll tell you. So when I said, I give you an example also here for you on the screen. Narrow banking is, I give an example. Maybe a bank is there specialized only in mortgage loans. They don't give other loans. They don't give loans for business. They don't give consumer loans. They're not active on credit cards. They just focus on mortgage loans. Okay. So that's a kind of narrow banking. Why they are doing that? They also have other products in their line. So they offer insurance, they offer broking, they offer trading account, they offer a kind of mutual fund activities or distribution. They have many. Okay. So fineness is all about horizontal distribution. Okay. Specialness is about the bank's specialization in core banking. They dig deeper into the same core business operations. That's the difference between specialness and fineness. Now, in this context, whether it is a specialized bank, vertically distributed, or a horizontally distributed finance banking, why they have to be regulated? Okay. The problem is the deposits of the public are with the banks. What happens if the banks fail to redeem their deposits? So that kind of risk is seen when the economy is in recession or natural calamities or war situations. There could be any man-made or natural reason which may hit the operations of the banking. They don't intentionally default. In case if they default, what happens? Okay. So they're regulated at the federal level as well as at the state level. And it differs, not always. It depends on the state's rules and regulations. This we discussed in the first sessions of monetary policy and Federal Reserve implications, while how they are framed and how they are implemented. Then these regulations could be beyond the country level also. They can also have the regulations on international banking when the American banks are going out of US and offering these services, or foreign banks are coming to US and investing here, doing their business. So when we look at this regulations, what I did is I classified all the regulations into 6 broad categories. Let's quickly look at them. So the regulations are related to safety and soundness, implementing or executing monetary policy, which we discussed in the initial sessions, credit allocation regulation, consumer protection, investor protection, entry and chartering regulation. So we have 6 here. Okay. A question to the class. Assume one of you or some of you have taken a student loan or car loan or home loan. Okay. Which regulation is relevant to you? Assume you have taken a loan. Yeah.
I guess you could say
Credit card. So you're saying credit allocation, you're saying? Okay. Anyone else? Would you like to try?
Consumer protection.
Sorry?
Consumer protection.
Consumer protection. Good. So you are the consumer to the bank, right? So you are borrower or lender to the bank?
Or
Borrower. Okay. Yeah, you're saying something?
I was gonna say opposite.
Asset allocation?
That's why
Okay, the same. Okay. Anyone else? You have taken a loan, some loan, education loan, or car loan, or home loan. So this is related to which regulation will be related to you?
monetary policy too.
Monetary policy too. Okay. Okay. So if we generalize, I think some way or the other, indirectly, you're related to that if you are a borrower. But if you look at specifically like a credit allocation, it is all about whom to whom the bank should give the loans, right? Whom to avoid giving loans. So all those are specified in credit allocation regulations. Monetary policy is much broader, related to implementation of the Federal Reserve policy to the economy. That's very broad. Safety and soundness is all about insolvency or bankruptcy problems related to the bank and associated stakeholders. Then consumer protection is where we all will be linked. We'll look at what kind of consumer protection the bank will give me. That's what we'll look at. I could be a depositor or I could be a borrower. You can ask me, I just borrowed from the bank. Why I should protect it? Remember, the loans are not free of cost. Most of the loans are given on collateral, mortgaged. So how the bank deals, if at all you got a problem, you couldn't repay. So you need, though you're a borrower, you need some protection. Then investor protection is different. Consumers are borrowers and depositors. Investors are those people who are investing in banks, buying the shares of the bank. Okay. So if you remember, we have discussed about small saving institutions, credit unions, they don't offer shares. Whoever puts their deposit, they become the owner or member of the bank. So in this way, if someone is investing in the bank, to what extent they are protected? American investors or foreign investors? Then entry and chartering regulation, it's more about new persons, new institutions entering into banking industry. So that is much broader. So all these six are completely different. We'll just give you the introduction, but quickly look more into it. So to start with, safety and soundness regulation, it has layers of regulation. Okay, we'll start with that and followed by other discussions. So what are those four layers for safety and soundness? To what extent the bank has diversified its assets? What do you mean by banks diversifying its assets? What are the assets of a bank, by the way? Yeah.
how much money they have loaned out?
Tell me.
How much money they have loaned out?
Exactly. The loans. When you're looking at balance sheets, the loans given are the assets to the bank. Then what are the liabilities? Deposits from the public they have taken. Okay. So when you're talking about regulation which looks at safety and soundness of a bank, to what extent the assets are diversified? So what do you think? The assets should be diversified or they should not be diversified to reflect the safety and soundness? Yeah.
So there's,
Yeah, I think those who have taken investments, much better than me or all of us. Why? Because investment talks about portfolio management and diversification. Okay. The objective of diversification is minimize the risk, maximize the return. So that's what is expected from a bank also. Then next one is minimum level of stockholder capital. To what extent the capital there is something called capital adequacy ratio CAR. To is that 8% or 9%? Higher the CAR, more the depositors are secure. Okay. Then guarantee funds. It's a kind of insurance for the depositors and monitoring and surveillance. Who does that? The regulator does that. Not only regulators, you also have commercial banks production of accounting statements, which are quarterly usually, and timely reports submitted. They closely monitor. If there is any deviation, they try to call the bank. So surveillance is much broader, but specifically to what extent they are diversified, and is there any guarantee of funds, and what kind of capital adequacy ratio they have. Then some insights into what happened related to this. There was a specific act called Consumer Protection Act 2010. This is introduced post 2008 recession. So this was introduced and signed into law by President Obama, and it has 5 objectives, important objectives. What are they? Fine supervision and regulation, broader comprehensive supervision, protect consumer and investors from financial abuse, they don't default the standards, and frame tools for the government to manage financial crisis like 2008 again, and raise international regulatory standards. This act is all about this. That was the first one, safety and soundness of the banks. And second one is monetary policy regulation. This is quite easy for us. We already discussed. Monetary policy regulation is all about the maintaining the liquidity and Fed rate. Fed rate goes up and comes down. We discussed on that. So open market operations committee will decide what will be the target Fed rate. If they want to cut the supply, they will increase it. If they want to increase the money supply, they'll cut the Fed rate, target Fed rate. We already seen this. Then the third one is credit allocation regulation. Credit allocation is all about to whom they are lending, what are the targeted social sectors in the economy where they need a support. I think housing and farming have been continually the supporting segments where the commercial banks try to give more loans to them. So most of the banks, they in their balance sheet, they always separate mortgage loans, farming loans. So why do they do is they want to show to what extent they have given to support them. They are to year on year, quarter on quarter, to what extent that proportion has gone. Then limits, the price limits, I mean, interest upper limit for to protect them, or it could be the prices or the fees. And we also have something called QTL. Who are the thrifts? You remember that we discussed in saving institutions, other commercial banks, other banks we have discussed. what do you mean by thrifts? Who are these thrifts? Can anyone of you recall? Okay. These are the saving institutions which are established to promote savings. And they also do banking. Okay. So there we have seen, in those discussions, we have seen there's something called qualified thrift lender. If that institution is a QTL, they are qualified to give loans. That is the idea here. So it can come through the Federal Reserve Bank to set up the maximum or minimum limits on the loan size or the interest rates. And coming to consumer protection, which we are talking about, depositors and borrowers, I think HMDA 1975 Act is more popular. It's popular because it has a lot of data. If someone is interested in doing a research or doing some project or analysis on housing in US, HMDA is the first free source of information. It is absolutely free. You can do, you can get whatever the data you want to, and it clearly gives you the data based on the age, race, or gender, or income. You can completely divide where the loans are going on. When the balance sheet of a bank shows something, some $80 billion given to mortgage loans, out of 80, you can distribute this. The data is readily available for you. And we also have a Community Reinvestment Act, CR or CRA, which is more referred for ratings ranging from outstanding to substantial non-compliance. And it gives you a fair idea on how good or how bad this bank is. Okay. Then the Consumer Financial Protection Bureau, CFPB, which was passed through in 2010, which focuses on unfair, deceptive, and abusive practices. One major example was Wells Fargo in 2016 was ordered to pay $185 million, okay, because of the illegal practices or banking abuse. There are many, but this is one of the biggest in the history of banking. $185 million penalty on Wells Fargo. Okay. Then further, the fifth one out of the 6 regulations, investor protection regulation. This is only about investors who would be directly investing the shares of the banks or indirectly through mutual funds or pension funds. Okay. So this is more related to Security Act of 1933 and 34, Investment Company Act of 1940, and Wall Street Reform and Consumer Protection Act of 2010, which we have seen in the beginning. So the idea here is to protect the investor against abuses such as insider trading, spoof trading. There are many where they try to manipulate the market for liquidity or wide bid-ask spreads or whatever. The last one in the types of regulatories is entry and chartering regulation. This is more about what kind of a bank should be allowed to be part of existing commercial banking industry, join the commercial banking industry. I think that is more important. Why? Because there are too many entries when the economy is booming, and too many exits when economy is not doing good in recessionary tendencies. So these regulations will give they define the scope of activities under the charter. They will change. They may change. It happened for investment banking when 2008 Lehman Brothers defaulted. Then the regulations came into the picture. All the regulators were active, and what should be done with the integration of commercial banking and investment banking, and how to separate them. We'll be seeing that more in the next session on investment banking on Thursday. So these more about barriers to entry and regulations pertaining to the scope of permitted activities, which is a net regulatory burden. So it's like safeguarding banking as an industry from unwanted competition. It could be foreign competition also. So that was about types of regulations. Now let us look at who are the regulators and what are the types. Broadly, I think as I told you in the beginning of the session today, FDIC is everything for banking. Okay? Of course, see, there is no one bigger than the Fed. Federal Reserve is always there. But while implementing and directly seen was FDIC is a big body. And we also have OCC, Office of the Comptroller of the Currency. And at the state level, we have regulation which vary from state to state. So when we look at a direct bodies regulating the banking industry, what exactly they do is they have different facets of the regulatory structure. They look at overall operations. Then they also look at product and geographic expansions. Product expansion is getting into commercial bank to maybe investment banking. Geographic extension is one state to another state, one country, or domestic to international. That's what you mean by geographic expansion. Then provision and regulation of deposit insurance, to what extent they're insured. Then balance sheet regulations. These are the direct regulations where we can see from the regulatory bodies on the commercial banks. So broadly, you can see the segmentation as commercial banking and investment banking. And within that, we also have many. Like commercial banking, when you're talking about, you need to take care of the deposits, you need to take care of assets or lending. Then investment banking has more. We'll talk about this later in detail in the next session. Then related to this implementation, important acts are Glass-Steagall Act 1933 and FSMA Financial Services Modernization Act 1999. Okay. What do they do? So the major framework of these acts, to start with Glass-Steagall Act 1933, is they separate. Glass-Steagall Act is more known for separation of commercial and investment bank. It was in a lot of debates in 2008 decisions. Okay. They look at the separation of commercial and investment banks. And they also look at separation in terms of government securities, dealing with government securities, private placements, trust services within investment bank, you can say. So this is a bit outdated, but some important fact on this. Commercial banks would engage in limited investment banking activity through Section 20 affiliates by 1987. Okay. Things have changed later because FSMA came into picture. It repealed most of the Glass-Steagall Act. Importantly, the barriers between commercial and investment banking, and it permitted commercial banks to be more into investment banking activities. And more on that, banking horizontally spreading into insurance and banking into other commercial activities. So it's all about Bank Holding Companies Act, which allowed banking and insurance affiliations. Then Gans Saint Germain Depository Institutions Act of 1982. They have restricted insurance companies from owning or being affiliated with full commercial banking operations. These two are focusing on insurance firms. Okay. Then again, if someone wants to get into commercial operations beyond commercial banking or to divest themselves into non-bank related subsidiaries, BHCA 1956 is a direct control. Okay. But FSMA, as I was showing you here, it changed the restrictions on ownership limits too with these regulations. You remember shadow banking that we discussed in the last session actually? Can you try to recall?
Like non-financial institutions that are banking.
Perfect. Simply a company, maybe Google is doing some banking activity, which is not a bank. Okay. So that's okay. But commercial banks started yelling on this shadow banking because the reason is they don't come under these regulations. Most of the regulations, what we have seen, they don't come under this. So you can also call them as NBFIs, non-banking financial institutions. So they're more into non-core banking activities. They're more into maybe credit cards or securities trading or insurance and so on. But they're much bigger in size. I think by 2022, they're of $152 trillion assets worth. They're much bigger, but they are not regulated by federal government. So again, regulations on geographic expansions within the domestic region or state to state or international. So for this also there were some restrictions on this. There are many intrastate borrowing regulations, except Iowa. Most of the states had regulations with intrastate banking, where restrictions on intrastate banking by commercial banks were implemented. So that was seen through McFadden Act, then Douglas Amendment to the Bank Holding Companies Act, which resulted, and they have passed some form of interstate banking law or act in 1994, all but Hawaii. Okay, that is about geographic expansion. Then there are more acts on this. Regal Neal Interstate Banking and Branching Efficiency Act of 1994. This allowed US and foreign banks to branch interstate by consolidating out of state bank subsidiaries into branch network. So this resulted in full state interstate banking is a reality in the US. This is good for banking as well as for the consumers who look at brand to borrow or take loan or put their deposits or any kind of banking activity. Okay. Then, as I was mentioning, the important discussion for the day, FDIC, Federal Deposit Insurance Corporation. It started in 1933. I'm sorry. And it was all good till late 70s. But from there onwards till early 80s, because of the changes in monetary policy targeting bank reserves rather than interest rates to lower the underlying rate of inflation. So this created problems for the commercial banks because they got suffocated. Increasing the reserve is not a joke. You have huge money piled up and you're so happy to give them as loans and earn money. But government monetary policy is saying that no, my dear, you have to put 10% or 20% of your equity or capital with you as a reserve. Okay? So, and at the same time, T-bill rates are also very high at 16%, too high. So this resulted in a negative spread in that period. I'm talking about late 70s and early 80s. And they're forced to pay competitive interest rates on saving deposits to avoid disintermediation. The core banking is intermediation. You can't run away from it because of the temporary changes in the interest rates. So that was not good for FDIC. And later, it overcome the effects of these volatile interest rates, where Congress passed regulation on DI's deposits taking and asset investment powers. So they made it a little flexible. So this is an opportunity to take more risk in attempt to return profitability. Then further in early 90s, to strengthen depository insurance, FDIC Improvement Act was passed in December 1991 to restructure FDIC. And the basic idea is to avoid a potential insolvency where the banks may bankrupt. But still, they were severely hit. That was experienced from 2008 to 2011. And federal government directly leveraged many banks so that DI failures will not occur. But it continued till 2019, and with some volatility in 2011. I think I got a time series chart for you. Yeah, this is what I'm talking about. So you look at this, FDIC, when was FDIC incorporated? 1933. Why in 1933 it was incorporated? Because of this spike. What does that mean? There are more failing banks in 1930s because of the Great Recession in 1930s. Okay. Then after that, just now we are talking about late 70s and early 80s. You can see there were some acts renovating FDIC, but still you can see this spike again. This is huge. 200, more than 200 banks failed. Okay, in 1988. Then after that, you could see in 2010, it was the highest, around 150 banks failed. That's not a joke. Banks failing is not a joke. And then since then, I think it was flat, almost close to zero. Then further, Federal Savings and Loan Insurance Corporation, FSLIC, was no more because Financial Institutional Reform, Recovery, and Enforcement Act was introduced in 1989. And FDIC got restructured. That's very important for the depositors and the economy as well. I understand this regulation is a bit a different flavor to know or learn for you all. So knowing about these acts is more important. because we are not literally working on problem solving or understanding the trends of the markets and so on. Okay, moving ahead. So FDIC is with commercial banks as well as saving institutions, but you can see around 9 trillion is with commercial banks and 0.9 trillion is insured with saving institutions. So when you say, I think credit unions are not part of FDIC, you remember that. Then moving ahead on this, in 1993, a risk-based deposit insurance program was introduced. And in 96 and 97, the fee structure was changed, where the healthiest institutions paid 0 cents per deposits, while the riskiest paid 27%. That's too high. No, 2.27 cents for $100 is 2.7%. Okay, this is so good for the banks. It justified good performing. It has rewarded. It has credited good performing banks compared to non-performing banks. Earlier, it was not that. So 90s has brought revolution to FDIC. Okay, it justified. So healthiest bank, which is maintaining good reserves, and it has very healthy balance sheet, sound, strong balance sheet. It almost need not pay any insurance premium for it. But companies or banks which are not doing good, they're supposed to pay more. That's good. So now it is not a plain, but it is linked to the risk-based deposits. So not only that, they also introduced a restoration plan for DIFs, which is part of the FDIC to restore DIFs. Now, we have seen kinds of regulations. We have seen who are the regulators. Now, directly looking at the balance sheet, what kind of regulations that we can have. Okay. If you look at this, the banks are looking at liquidity for regulations. What do you mean by liquidity here? How does a bank look at, what do you see? How do you see liquidity from a balance sheet of a company? What do you mean by liquidity?
Current assets.
Current assets. Okay. Yeah. Cash, part of current assets, right? So when you guys are looking for liquidity of a company or corporation, you look at balance sheet. And within the balance sheet, you look at current assets. Now, one more question to you. Are the current assets same for a banking industry as well as non-banking industries like manufacturing and services or whatever? No? Why? You got what our friend said that? She says current assets are different for a bank and compared to a non-bank. Why that? Can you help her? You get the question? I can repeat if you want. Again, I repeat it. The discussion here is when we look at liquidity of a company, of a bank or a manufacturing company, the current assets are different for these two. Correct? But my question is why they're different? What makes current assets different? Okay. You look at manufacturing company, services company, and a banking company. When you look at these three, their liquidity demands are completely different. A manufacturing company heavily relies on its inventory for their production process. So inventory, raw materials or work in process or whatever, that is everything for that company. That may not be of importance when you look at a services company, any services company. And it is further very much of low importance when you look at bank. For a bank, cash is everything for current assets. They don't look at raw materials or something. Okay? So when you look at liquidity of a bank, it is all about maturity matching. When you have deposits maturing in the coming 1 month, coming quarter, or a year, or coming 3 years, okay, what kind of assets are matching these deposits? That's the beauty of managing banks. Okay, maturity matching is very, very important to look at liquidity. If you are failing this, deposits are, say, for example, $80 million of deposits are maturing in the month of March, by 31st March. But you don't have repayments of your loans to that extent. You have only 20 million, say, for example, 80 millions deposits which have to be repaid and 20 million assets or repayments. So you are shorting 60 million. So what do? Go for borrowing, short-term loans, interbanking lending and borrowing happens there. But that's not free of cost. Okay. So this is what you talk about liquidity, which is clearly reflected in balance sheet. So, so in US, the banks must hold a target minimum reserves against net transaction accounts. To come out of this kind of risk, they maintain a minimum reserve to offset any kind of liquidity issues. So for example, if it is less than 15.2 million, 0% minimum reserve. If it is 15.2 to 110 million, you should maintain 3% reserve. If it is more than 110.2 million, you have to maintain 10 million, 10% reserve. Okay. So based on that, balance sheet regulations are applied. So all these things came from Basel. Basel is a global benchmark for liquidity maintenance or investor protection or consumer protection regulations, straight away hitting capital adequacy ratio. Okay, so this has become of more importance since the financial crisis of 2008 to 2009. Then they updated the capital requirements based on the market risk from banks trading operations. So they extended their objectives to strengthen the risk coverage and capital framework, and also to raise quality, consistency, and transparency of the capital base. So it is a 2-dimension or 3-dimension regulation. So some important ratios for your evaluations or assignments point of view. These are quite important. Please make a note of that. So we have tier 1 risk-based capital ratio. This is what they talk about. Then total is this plus tier 1 and tier 2 as a weight of risk minus weighted assets. Then tier 1 leverage ratio, tier 1 capital compared to total exposure. So when you say exposure, total loans given, that's the risk the bank is bearing. Those are the assets too. Okay. Then when it comes to specific capital categories from prompt corrective actions, you have different zones, well capitalized to critically undercapitalized. In between, you have undercapitalized. Okay. You have respective percentages which decides the tier. Then this is tier one risk-based ratios. This is the leverage ratios. So you can cross-check to uh, plot any kind of a combination. For example, if it is a well capitalized and tier one leverage ratio, you should have 5% or above. Okay. So these are the categories under this list to have a fair idea. Then again, we have something called risk-weighted assets. Assets in totality cannot be shown as assets based on their risk nature. What do you mean by risk of the assets? All the assets doesn't carry the same level of risk. Mortgage loans have a different kind of risk exposure compared to business loans. Long-term loans have different exposure compared to short-term loans. So like that, based on the risk exposure of these assets, they are weighted. Then the same is reflected on the balance. This is a very good norm for regulation as well as the investors or consumers protection. Then okay, they also impose some surcharge and global systematically important banks, which gives improves quality and transparency to assess the bank's credit worthiness. Then finally, to have some comparison of regulation of American banks and foreign banks, there is something called ODICA or Overseas Direct Investment Control Act of 1964, which targeted to restrict US banks' capacity or ability to lend to US corporations that wanted to make foreign investments. What do you mean by this? So, US corporations want to invest in foreign countries, but at the same time, they have the ability of US banks to compensate the target that was tested here, so that American corporations' money is not going out of America, it's staying here and channelized to the banks. That is the idea here. Then offshore funding and lending in dollars created the beginning of the euro dollar market. Then USA Patriot Act of 2001 was amended to establish standards for screening customers who open accounts at financial institutions. It's very important. Their national interest should be reflected while doing these operations. Okay. A quick comparison of the regulations. There is something called International Banking Act of 78, which declares foreign banks are to be regulated same as national domestic banks. There is no privilege, or there are no additional penalties for foreign banks. They are at par with the national banks. So I think we just discussed charter regulation. So this is more related to those regulations. So but the regulation or requirement is that they need to hold Federal Reserve specified reserve requirements. Okay. Maybe they're operating in a different country or following a global standard, but when it comes to operations in US, they need to follow the stipulations. And it is more if their worldwide assets exceed $1 billion, if they're much bigger. Then, but specifically, the foreign banks also are prone to McFadden and the Glass-Steagall Acts, where they have separate sections to deal with foreign banks. So in addition to that, you also have Foreign Bank Supervision Enhancement Act of 1991, which is an extension of Federal Regulatory Authority, which has focus on entry of the bank, exit of the bank, evaluation of the bank, accepting deposits, and to what extent they are powerful in executing their activities in banking, horizontally or vertically. So it's not the, they say that foreign banks are operating at par with the domestic, but they have separate regulations. You need to differentiate that. Okay. Importantly, their entry. Closure or disclosure. Closure is also important for a bank because deposits are there. Okay. People have borrowed. It's not that easy to exit. Then that's it. All about the regulation nationally, internationally. So to conclude, a quick recall, we have seen types of regulations. How many types of regulations we have seen? 6 types of regulations we have seen. And we specifically worked on charter regulations where commercial banks are restricted on entry into the banking industry. And we also have seen commercial banks extending into investment banking. And we focus more on FDIC, a lot of acts. FDIC started in 1930s, and later on it got changed. It got a lot of updates for more flexibility. Then we compared regulations of domestic banks or US banks with other countries. Then we also have seen capital regulations, that is capital requirements based on the risk exposure. Then why commercial banks are subject to reserve requirements, we discussed, to protect consumers' interests as well as to have more transparency and strengthen the balance sheet. Okay. So this is all we had. If you have a question, you can ask me. Any question? Okay. I understand this is a little more descriptive. The regulation is all about that. Next session would be more interesting. We'll be talking about investment banking. Thank you all for your wonderful interaction. Continue the same in the next session. See you all on Thursday. What's up, guys?